Hi, my name is Dan, and welcome to Market Philosophy for Beginners. Before we get started, make sure to hit the like button, subscribe, and hit the little bell to be notified of upcoming content. My core philosophy is a community that learns together, earns together, and you can join me and the rest of the Games and Stock crew on Discord, where we react to the market live, as well as on Facebook and Twitch and YouTube. You can see the description below for links. Now let's begin. As long as you're not doing margin calls and as long as you're not shorting the market, you can only go to zero. If you use $300 in the stock market, you've been probably broke before. And the best advice I have for you is when you buy into that market, in your head, try to create a space for your brain to consider that money spent. And I think I was talking to somebody earlier. I used to work in the car business. I used to sell cars and spend 14 hours a day in the dealership a lot of times. And then I had National Guard drills on the weekends that I had off, and I mean, it was nuts. I spent so much of my time working. I didn't really have a social life. I didn't have any life other than the people I worked with. Well, some of the things I did is I spent money on like guitars. I own 3 of these things, and I've owned them for probably about 8-9 years now. I still don't know how to play them. Right? I was trying to fill my time in with that stuff. Nowadays, I get that little dopamine rush, that spend money dopamine rush, because I got to buy another share of GE today. That's a win. Or I got to buy another share of US Concrete today because of my profits in Ideanomics, right? And the way you start doing this with the penny volatile stocks, right? The biggest rule is you want to pick something that's not a scam, and that's not always the easiest thing to root out. And for example, Ideanomics here, I don't think is a scam, but it's still possible that it is. That's the truth. I don't think so. I think they've more than proved themselves, having sit here and participated with this the entire time. But that's my most heavily invested thing, and my most heavily invested stock is still Ideanomics, and I think it's gonna keep going up, and it's cheap. I started buying this at 86 cents a share. It's now 4 or something, and I swing it. It fluctuates 10 to 20% a day, and it's pretty darn predictable about it. All right, so I'm gonna make a map here on what it's like if you've got $300. All right, you can shrink this model down. You can scale this model up. All right, once you start engaging with the market, you're gonna be able to make your own model and make your own rails. All right, so you don't have to do it exactly my way, and you don't have to invest in any of the stocks I'm saying or anything like that. I'm trying to teach you the theory behind it, the philosophy behind it, so that you can learn to make your own decisions about the market, because everybody's going to co-opt you and try to get you to buy what they've bought. I mean, so everybody's got an interest in misleading you in the market, myself included. I talk about Ideanomics, I talk about AMC, I talk about the things that I'm invested into, because I have a biased interest in making sure you also invest into it. So I guess at the end of the day, I want to teach you some simple rules you can follow while you're learning what the market is and how the market behaves. And again, I'm going to show you that sine wave again. What is it, animated? Yeah, okay, that. Okay. One of the first ideas to understand, you look at the stock market, you look at Webull, you look at this stuff, this is intimidating as hell. How are you supposed to begin with looking at this, all right? And I'll be honest, in the beginning, don't really worry much about the charts. You're going to have to look at patterns in the charts on your own, and you're going to see them on your own the more you watch them, the more you expose yourself to them. But really, everything is going to be based off of this number right here, and this number right here. Everything is a yield percentage to your portfolio's sum total, okay? So we're not going to worry about all this intimidating stuff. The only thing we're going to really worry about is what do you want to own? And I'm going to start with the first thing that you need to find are your stable stocks. Dustin was in here earlier. He listed GE and Ford as potentially stable stocks. I'm not sure about Ford. I don't look at Ford, but I'm pretty sure it is, and he's on the right track. GE is relatively fairly stable. Hmm. So,
I mean, apart from blue chips.
well, and we can blue chips count as stable stocks too, but not all stable stocks are blue chips. And I guess that's what I want to say. I tend to call my stable stocks when I'm talking to people blue chips. I'm not really referencing actual blue chips. I'm referencing what my most stable places are. And you want the bulk of your account to sit in the stable stuff. All right. So if you've got $300, 200 goes to stable. Okay. This is so important. This is what protects you, and this is what allows you to leverage liquidity later on, right? Like, and I'll come back to that. Liquidity is key.
You could say, like, in the crypto.
Oh, again, you see how this works. Does this make, like, what's happening in the stock market make a little bit more sense? So in the center of the circle is your average share price, and what's happening in the market is the price oscillates around that average share price as people ask for shares and sell their shares. So this is how the flux is created. To create a model of that price point rolling around like this in your head, it's not easy to do. So I don't expect you to do that. But like, I want this image burned in your brains, because you have to understand that the business market is it's cyclical. And that is partly why you can more or less predict it, because the business cycle, it happens. That's why that when you look at the stock market, it looks like a heart monitor. You're seeing the cycles. So one of the things I noticed is I saw a good entry point for Starbucks. If you want a stable stock that's really expensive, that's a slow mover, Starbucks. And I'll show you why here. Ford's probably really good too, and I'll look at Ford and we'll kind of digest the chart a little bit together. The chart is a snapshot. Because I've learned to understand the charts a little bit, I'm able to look at the shape and kind of make some guesses about the company's behavior. Now, this is called a candle chart. This is really the only chart I ever use. There are different types of charts, and you can set them up different kinds of ways. I'm sure there's uses to all of them. I'm really, again, an amateur, because there's a billion different metrics you can use to gauge the market. And that's all you're really doing, is gauging the market, how to interpret the data in front of you into something you can use to assess risk and assess probability. All right, so when I look down here at range or interval, okay, 5 minute, 1 hour, a week, 15-minute, day, month, quarter, year, you can set this pretty much anywhere you want. When you set an interval to daily, this is a daily interval, each one of these little candle patterns, these little spiky thingies, okay, they represent a day and a tick. All right, so the top of that spike is the highest price it traded at, the bottom of that spike is the lowest price it traded at, and the color indicates whether it was trending up or trending down. Okay, the trending is important, right? That's why there's color there. You'll start.
When you say spike, are you referring to the wick?
It's the outline. I'm talking about the whole candle. The whole candle is spanned from the top of the trade to the bottom of the trade for that tick. All right. So this is the highest point it traded at. This is the bottom point that it traded at during this 1 day cycle. Yeah, wicks can be pretty extreme, and in some cases, especially like when a acquisition happens or a purchase happens, you get some backdoor stock deals that, like, yeah, look at this wide gap, but marginally not much changed, right? That means it pretty much closed at the same price it opened for that tick, even though it traded wildly throughout the day. That's what those smaller like means. But that's also the squeeze, and you'll start to understand those patterns as you look at charts. I'm not really telling you to worry much about the chart, but I'm going to talk and use this chart because it's going to make my job quicker as I try to analyze this. The reason that I think Starbucks is probably not a bad place to start with a more or less a blue chip or a stable is where it's currently sitting in the market. This shape right here, and then these 3 ticks. Okay, so it's trending downward, but it's got a moving average that's trending upward. This is the next business cycle forming. And if I zoom out, and of course my mouse wheel is going to zoom slowly, this is a bowl filling up. Essentially, this is a cup and handle that formed. It went up, it's going to go down, it's going to accumulate here for a little bit, and then it's going to go up again. All right, that's what I would expect it to do. This is pretty much where the floor is. You see how this gets linear right here? Instead of it having a sharp scoop in these candle wick patterns, it's straighter. That's because this is more of a floor. And what that tells me is there's more people that own Starbucks at this 90, I said it earlier. There's more people that own this Starbucks at this like 97, between $95 and $97 than anybody else. So when I look at this sine wave, I put that in my head, that $97 goes right in the middle of this circle. Right in the middle of this circle. So we'll split that in half. So right there. So what'll happen is it'll likely dip below this just a little bit, and it'll do like a W kind of thing right here. This is accumulation that happens, and then it'll go whoop up. So if you want an institutional, you've got some wiggle room for this to move pretty nice, because it'll go from this 97 probably up to 107. That's $10. All right, but this is the problem. If you only have $100 or $200 that you're throwing at that, you could only own 2 shares of Starbucks. So if that made that jump, you'd make $20. And that's not let's make money, that's good, but that's not exactly what we're here to do, right? The reason you do this is because you need somewhere to park the capital you're currently not trading, and the bulk of your capital should not be being traded. All right, so Starbucks is fairly stable. This is a good entry point. I would say pull the trigger. However, there are exceptions to the rules when it comes to these prices, and one of them, in my opinion, and it's my opinion, it's not a fact, is General Electric. So I treat General Electric like I treat a blue chip. All right, I parked quite a bit of my capital in it. I bought it in March when everything went to shit, because I think there's value in the name brand alone. I don't think General Electric's going to go anywhere. I don't think it's going to leave the country. I don't think it's going to get delisted or anything like that. And positive drift in the market says naturally it's going to go up, and I was absolutely correct. I think I originally had an average of about $6, and it's now trading twice for that. And to be able to double your money on a company like GE, that's really cool. Like, it feels really good. But GE does about a 3 to 4% ride here, all right, in the cycles. Look at its cycle. This is about a week at a time. See, these are week, maybe not week. Maybe I need to do month. There we go. Okay, so these are month markers. These candles. And what you're seeing here is this is Corona. Woo! This is Corona. This is recovery. So each one of these, it's filling back up. But it doesn't move much. So like my money just sort of stays there. And then if it goes up and I've got like $50, $60 in profit there because I've got so much money parked in there because it only went up a little bit, I'll then sell a share or two, take that $50, $60 out, and I'll take it to somewhere like Ideanomics. And I can get into a story with Ideanomics for a long time. But we're going to come back to the Ideanomics. We're going to call that penny slash. But the reason I showed you General Electric is you can own quite a bit more General Electric than you can own Starbucks for a lot less money. And when you do your risk versus reward assessment, having more shares of something usually does put you in a better position. So when it comes to your stables, price is important. Another one of my favorite stables is U.S. Concrete. And that's because logically I think, and politics does play a role in stock market, logically I think U.S. Concrete, there has to be an infrastructure bill to bail us out what's going on in the economy eventually. It has to happen. I don't know when. Could be 10 years from now for all I know. But what I do know is most likely U.S. Concrete will probably always have value. Will probably always go up. And I've owned U.S. Concrete since, we'll go look. My positions, USCR. Now, I've changed my position multiple times in U.S. Concrete. Dang it, I don't really know how to look at my my trading history from this. I'm usually using the phone app to do all of my stuff. I don't really use this. This is great. This interface is great, but it's really intimidating even for me. There's so many things and so many little things I can use to measure and gauge, and I don't even know what half of this stuff does, truly, because I don't need it. It's actually a lot simpler than this all makes it out to be. This is just arming you with an endless slew of tools to help you make your decisions. But so instead of, like, you can own either stable wise, like let's compare like GE to Starbucks. You could either own 2 shares of Starbucks with your stable money, or you could own 90 shares of GE. To me, knowing the value I think GE has, it's a no-brainer. Correction, 15 shares. But you need to find your own GE, or you need to find your own Starbucks. You need to find your own logic-driven path as to where you're putting your money in stable coins. If I could give you any caution, I'd avoid both Apple and Tesla. They're too goddamn expensive, and although they very well may continue just to trend up for all eternity, it doesn't make any logic or rightful sense. And I think putting your money into either of those two is like putting your money into the Stonk Wars stocks at the moment. Sure, something's supposed to happen, but it's utterly unpredictable, and you can't say anything. I can talk more about that stuff in the future, like the Apple and what I think about Apple. You know, Apple's a $1 trillion market cap. Do they have $1 trillion value on society? I don't think so. I don't think they provide $1 trillion worth of value to society. So why are they worth so goddamn much? It doesn't make any legitimate sense. Tesla, on the other hand, you could argue is like the GE of the modern era. So, like, I can see Tesla's value a little bit, especially with, like, Elon Musk being the celebrity that he is, you know, being the cult of personality, and, you know, with a boring company. I don't necessarily have to agree with all of his logic. But again, I'm going to remind you, like, these guys are smart, and I know sometimes from the bottom line, it seems like the gap between your level of smart and their level of smart is like this massive thing. But guys, it's not. A lot of what makes them look smart is that they just take action. It's not that they're actually intelligent. They just make decisions and go with the flow. And I promise you, sometimes that's kind of what you do in the stock market. And the way this works is, if I own, so 200's gone, 2-to-1 ratio, right? I've got $100 left to play with. You don't have to put it all in one place, but when you're dealing with small money like this, don't spread it out too thin. Okay, so like 2 stables, 1 volatile is probably what I would recommend. Okay, so what I'm going to then do is say, okay, we're going to use a hypothetical volatile stock, because the last thing I'm going to do is recommend one. That's not what I'm here to do. If you really want a recommended volatile stock, you can go into the Discord. The Discord's loaded with them already. We've been talking about them all day. Doge is considered volatile. Doge is a perfect example of what a volatile stock looks like. That's a super volatile stock. Even though it's a crypto coin, it's the same thing. Okay, it's still an asset that you buy with cash that you can trade. A stock isn't any different. And you're franchising into the company when you buy a stock. You're franchising into the crypto coin when you buy the crypto coin. So, to make life easy for the math, okay, 100 shares cost $1 each. So that's $100, right? Probably put that in the wrong order. All right. Who cares about when you enter? Who cares about when you exit? Like, get that stuff out of your head. You're a beginner. You're not going to try to time that shit. You know, sell high, buy low, buy the dip. These are memnotic rhythms you're going to want to keep, like, telling yourself, because you got to tell yourself that over and over and over again to start seeing the pattern, to recognize, oh, this is the dip. Oh, this is the high. You know, you've got to say that. But in the meantime, when you're just beginning, don't worry about what your entry point is so much. You can fine tune that as you get experience under your belt. The reality is now you need to start playing the market. So if I put 100 shares in, so now I have 100 shares. What are we going to call our fake little stock here? We're going to call it Win, just because I said so. Let's say Win goes down to 0.90. Now you need to buy. Now what do you do? Okay, so it just dropped. 10%. Okay. Now, when this happens, the first thing that you need to consider, how many shares do I have? I have 100 shares. How much liquidity do I have? Well, let's say you've got, just for the hypothetical sake, let's say you got 50 here and you got, no, let's say you bought, what is it, $12 a share? Let's say these GE is $10 a share right now, just so we can do the math simple. So you own 20 shares of GE, right? But GE goes up and down 2-3% at a time. You want to wait until this aligns a little bit. But when you've got profits in GE, I can sell off some of my shares in GE, right, to cover down, because I want to buy 50 shares of Win right now. So I've got to figure out, and this is not as hard as it looks, and this is probably the most thought I've had to put into this, so that's kind of why I'm stumbling over my words. I'm not kidding about that. That tells you don't have to be specific or like accurate to the penny, all right? You approximate this. I'm going to try to be accurate so that you can understand what I'm doing. But when the price drops 10%, you buy more stock. That's what buying the dip is. But get this. Price could drop to 80. Okay, then what? It dropped another 10%. You can buy more stock, all right? Every time you do that, you're going to dilute your average share price. So as the stock goes down, this is what you do to improve your position, right? Because you've got to be in position for when the stock goes up to make money. It has no matter what your entry point is or exit point is. You get better at predicting that, and then you can get better at day trading, but in the beginning, you're not going to predict that. You're just not. I can't even predict that. Okay? I'm not bad. I have a pretty good success rate, but I can't predict that. So let's see here. Let's go back to dropping 10%. I want to buy 50 shares. So what does that do to my average share price? I buy 50 shares. And mind you, I'm pulling out a calculator. Your platform shows you this stuff automatically. You don't really have to sit here and break a calculator and do this. I'm a little brain dead right now and a little overwhelmed. So I'm going to try to do this without making a whole lot of mistakes, and bear with me. The concept is important. So if I now have 150 shares, how did I, let's see here, 50 shares times 0.9, 45 shares, so 145 shares, or no, $45. So let's take, let's estimate I can do this exactly. I can't. In the real world, it's not quite specific, but we're going to take $45 out of your stable. So now we're taking our stable down to 155. All right. Now we're bringing our shares up. So we got 100 shares at $1 each, and now we're going to have 50 shares at 0.90. Okay, so that gives me 150 shares. Hold on. 45. So 145 divided by 150. So that dropped my average price per share down to 96 cents. Right? This is how you diluted your stock value. Correction, average share price. Okay. So this is a volatile stock. It swings both up and down. So like, okay, it swung down to 90 cents. It hovered around 90 cents for a couple of days. Okay, its down streak is over. It's about to go up. All right, it's starting to go up. When goes back to $1. Okay, you're already in the green. The stock didn't have to go as far to get you to profitable. It only had to cross 96 cents. It didn't have to get the whole way back up to $1. So you bought yourself down to a better position to be profitable. And that's the concept you need to understand as far as what buying down or covering down is. And I don't think I explained that good enough. You just made money. Had you not bought down though, you would have only broke even. That distance, that gap is small. So by buying more shares and it going back up to $1, which, I mean, it can do that in the blink of an eye when you're talking high volatility stuff, because to recover 10% is nothing. you cut your average almost in half between the gap of where it's trading at and where you bought it at. All right, so if the average share price now, if your average share price is 96 and it's trading at $1 and you have 100 shares, so that's 0.04 times 150, you just made $6. That doesn't seem great. That's because it isn't, and you shouldn't sell yet. When win goes to $1.10. Okay. You got 150 shares at $1.10. Now, your $150 investment just became $165. It just grew that, right? And this will happen all within a day. You'll have swings both directions in the same day on the same product. Like, seriously. So like, you can babysit this and you can get really efficient at this. But what you do here, so they're trading at $1.10. I made $15. So $15 divided by 1.1, so 13. So I'm gonna sell 13 shares. So I had 150 shares. At 0.96 average, sell 13. Collect 48. Okay, this doesn't seem like a big deal because that doesn't seem like much. But you take that money, and if you can buy another share of GE with it, that's a success. You just recuperated your GE. So like, let's say I take that $12. All right, GE shares trade at, you get how this works. Like, as the oscillates go back and forth, you just keep cutting your profit back 10%, drop your share price, drop your average share price. You know, I'm not sure if I'm making a whole lot of sense since I don't have a whole lot of engagement right now. Okay, so you're following along. So this is like the guide rails, all right? This is like bumper cars, all right? This is as stupid simple as I can make it for you, because what you pick doesn't matter if you follow these principles. Now, you don't have to sell off at 20%, like, because $12 isn't much, right? And when you're playing with small money, this is why you learn the most with small money. You can let that ride, okay? And really what you want to do is you want to let it ride until you can afford to buy one of your stables without dropping your 2-to-1 ratio. You want to recuperate that 2-to-1 ratio. If you don't, you're going to wind up a bag holder. A bag holder just means you ran out of liquidity, and likely now your only option is to spend actual cash back into the brokerage to cover down. It's better than selling for a loss, I promise. Explain that at some point too. And that happens, okay? I've made many mistakes in doing that, and it's sort of what happened to me with Ideanomics when I first started investing in Ideanomics. I made some amateur mistakes, but I made a lot of money playing it. I could have made I could have, and the difference isn't that I missed out on much of anything, really. I lost a lot of opportunity. The money that I made on it, I could have made probably 5 times as much if I knew what I was doing. I still made a lot of money though, okay? And that's what happens as you get better with the market. Be okay making a little bit of money. The goal is to trade often and trade small. Thank you for watching. I genuinely hope this acts as a stepping stone on your path to financial literacy. Make sure you subscribe and smash that like button and hit the little bell to be notified of future content. Remember always, a community that learns together earns together. You can find us on Discord where we react to the market live, and you can also find us on Facebook, Twitch, and YouTube. See the description below for links. Thank you very much. Happy earning.